Good afternoon and welcome to the final session of HUECU's Personal Finance Summit. We are so grateful that you all could be with us today and if you've been with us throughout the week. My name is Sarah Scruggs and I am the Community Engagement Specialist at Harvard University Employees Credit Union. I also have Migdalia Gomez on with me, HUECU's Community Engagement Manager and the moderator for today. Harvard University Employees Credit Union is proud to be Harvard University's not-for-profit financial institution, serving our community with customized products, services, and financial education, such as our Personal Finance Summit. Our sessions are being recorded and will be shared via email this afternoon. Please feel free to share these recordings with those in your circles who you believe could benefit from them. Throughout today's presentation, please do not hesitate to type in the Q&A box any questions you might have for our experts. We expect to have time for those questions toward the end of our session today. We also have a survey that will be shared in the chat, so please let us know your thoughts on this session or any that you've attended so far so we can continue making these programs a success. If you do fill out the survey, there will be an opportunity to be entered into an HUECU swag box giveaway. For today's session on decoding the fine print, we have HUECU's CFO and one of our branch managers joining us. Katie Armstrong has worked in financial services for over a decade and has been with HUECU since November of 2020. Prior to working at the credit union, Katie served as the CFO for Boston Firefighters Credit Union in Dorchester, Massachusetts. And prior to that, her professional history included roles at Admiral's Bank and the auditing firm Wolf & Company. Katie is a CPA and received her MBA from Suffolk University. Carline Olivier-Guerrier is a branch manager with more than 20 years of banking experience. Carline has proven skills in leadership training, customer service, sales, and operations. She currently manages the Longland Medical Area Branch at Harvard University Employees Credit Union. Carline earned a Bachelor of Science degree in Business Management with a concentration in Human Resources at Curry College. Carline is a member of the National Black MBAA, NAACP, and National Association for Professional Women. I'll go ahead and pass it off to Migdalia, who will be our moderator for this session. Thank you so much for being here.
Thank you, Sarah, and thank you everyone for joining us. So the way that our presentation is going to go today, we're going to have some questions and Katie and Carline will take turns answering them. As Sarah mentioned, if there's anything that we could clarify, please let us know in the Q&A and we will get to those. So we're going to start jumping right into decoding the fine print. One of the things that we really try our best to do here at HUECU is to make sure that you understand the financial piece. We want you to be comfortable with our products. We want you to be comfortable with any products that you borrow, whether they're with us or with someone else. And really, we wanted to take this time to have Carline and Katie help us understand those things that sometimes could be a little bit tricky and provide their expertise. So the first question I'm going to ask Katie, and it's going to be, what is the difference between an interest rate and an annual percentage rate?
Thanks, Migdalia. So interest rate and APR are very similar terms. And in some cases, they can even be the same number. So an interest rate is the rate of interest that you're going to pay on a loan. And it's usually stated as a percent that you're charged on an annual basis. So 2.99% can be your interest rate. An APR is a bit of a broader term. It includes interest rate, but it also includes any additional costs that you need to pay in order to close a loan. For example, on a mortgage loan, sometimes you may pay points, and there are always going to be origination fees and closing costs associated with the mortgage loans. So those are built into the APR. So if you're on our Mortgage Center homepage, you'll notice that we list an interest rate and we also list an APR. And the APR is always going to be slightly higher than the interest rate. And that's because the APR includes the interest rate plus the additional costs and fees associated with closing the loan. In some cases, when there are no fees or costs to close a loan, then the interest rate and the APR are going to be the same exact thing. And then lastly, one important thing to understand about the APR or the interest rate is that sometimes you're going to see that we offer an introductory APR. So your APR for the first 12 months, for example, is going to be one thing or one number. And then after that introductory period, your APR is going to switch to another, usually increase to another percentage. So it's important to understand that the APR that you're given at origination is not always going to be the APR or the interest rate for the term of the loan. So it's important to understand what your interest rate and APR are throughout the term of the loan. And that's really it.
Thank you, Katie. The next question that we have is for Carline, which is, what is the APY?
An APY is really an APY, annual percentage yield, and that is an interest rate that is put into your investment toward the end of the year. It does take effect, and it takes into consideration that you are compounding your interest to make it to that APY. So a great example of that is if you have a CD that you will see a lot of time that it would give you an interest rate of perhaps 2.10%, and then an APY, an annual percentage yield of 2.12%. In order for you to get to that 2.12, the interest has to stay within the CD throughout the term for the year. So therefore, the interest is reinvested, getting your investment to be larger and therefore yielding you that annual percentage yield called an APY.
Thank you, Carline. So we're going to stick to these types of questions and trying to really, when it comes to borrowing a loan, understanding rates is really important. So thank you for providing that context. The next question is going to go a little bit deeper into the difference between the adjustable rate and a fixed rate loan.
So I'll talk about the fixed rate loan first, because that one is the simplest one. Your fixed rate loan is the rate that your loan will have basically for the entire term of your loan. If it's 12 months, if it's 5 years, that rate doesn't fluctuate whatsoever. It stays on your loan, and the payments are the same every single month until you terminate the loan, you pay it off, and it stays the exact same way. Your variable rates are rates that are put into based on what the market is doing. So a variable rate is set on your index rate plus the margin that the bank will add to it. For example, a credit card can have a variable rate of prime, which is right now at 3.25 plus 5%. So your rate would be at 8.25% on that credit card or on that loan. And if index or the prime rate goes up, then your rate will go up, hence the variable. If it goes down, then your rate will also go down as it is, because so it's going to fluctuate based on what the prime rate is set as. Now, the third component of that is also what we call adjustable rate. And typically that is used on the mortgage side. And an adjustable rate mortgage, on ARM as they call it, typically is when you have a mortgage, it's a 30-year mortgage, and you have an ARM on it, the adjustable rate mortgage. It can be 7-6, for example. So the 7, the first part of that means that the first 7 years, you have a fixed rate interest. However, once that time elapses, it's going to roll over or be variable or readjusted every 6 months until the 30-year is exhausted. So after the 7 years, your rate is going to be every 6 months, whatever the index plus the margin rate set by the bank. is going to be, that's what the your rate is going to be. So hence the difference between the variable and the adjustable rate.
Thank you. That is something that we see very often with a lot of different products, so it's helpful for folks to have a better understanding. And I do want to remind folks, if you do have any questions, just use the question panel and we will get to those shortly. The next question that I have is for Katie, and it's going back to rates. We're really focusing a lot on rates since we know that's such a foundation. So how will I know what rate I will receive?
So this can be a little bit of a complicated question just because rates are determined differently depending on the product that you're applying for. And also different individuals are going to receive different rates depending on their credit worthiness, which involves their credit score and sometimes in some cases their annual income. So deposit rates are pretty straightforward and you can find all of them listed right on our website. In most cases, you're going to receive the rate that's on our website. In some cases, you might be eligible for a higher interest rate on certain deposit products if you meet certain requirements. So it's important to understand what those requirements are. And then for loans on the website, sometimes you're going to see the rates stated as interest rates as low as 2.99%, for example. And this is where it gets a little bit more complicated because the rate that's on our website is going to be the lowest rate that a member could potentially be eligible for, but that doesn't necessarily mean that's the rate that the member is guaranteed to get. So when you apply for the loan, you're going to fill out an application and you're going to give us certain information, and we're going to take that information and based on your credit score, your income in some cases, along with the loan amount, the collateral that's securing the loan, all of these factors are going to be kind of put into a calculation and your rate's going to come out of that. So more credit-worthy borrowers are going to receive a lower interest rate. And then if your credit score is a little bit worse, for example, you might receive a bit of a higher interest rate. Bottom line is if you're ever unsure of what the interest rate is, you can always feel free to ask. I know there have been times when I've gotten loans, maybe from a dealership or something, and it's definitely not clear what your rate is. So if you ever feel that way leaving the credit union, definitely ask. We give you a lot of paperwork and there's a lot of disclosures that you're going to receive. So it's not always going to be completely clear. So never feel unsure. If you have any questions, always feel free to ask.
Thank you, Katie. And thank you for that reminder for folks. We definitely want you to feel comfortable in whichever product you choose. The next question that I have is for you, Carline, which is, how do I know what my monthly payment will be?
Well, for your monthly payment, with so many different ways that we can work that out. We do have our calculators on our page. If folks are very tech savvy and they're okay to go in and find the calculator. We also have meetings that you can set up with us, whether it's virtual, whether it's in person, and we will definitely determine that for you as well. And we also have our support center. Feel free to call them and talk to them, and they will pull up the calculator and work with you and determine the different, terms, the different rates that we have, what would work best for you and your budget.
Thank you. Then I have a question I'm going to ask both of you. And I know we have a lot of different products, so I'm going to sort of ask it in two parts. I think I'll start with you, Katie. And the question specifically is, what does it mean to have interest compounded? And can you speak specifically to student loans?
Sure. So compounding interest can work in your favor in some cases and against you in other cases, which is why it's really important to understand what it means and whether or not it's built into your loan product. Unfortunately, with student loans, it's one of the areas that's a little bit less in your favor. Am I still on?
Yes, you are.
Okay.
And we can hear you.
The term this is a typical term with student loans. Most of them have compounding interest. So while you're in school, you aren't required to make any regular payments. However, the interest is accruing during that period of time. So you're being charged interest despite having to make regular payments. And then once your loan goes into repayment, which is after you graduated school, and then there's a grace period, and then your loan will go back into, or will go into repayment. And at that point, all the interest that's accrued during the time that you've been in school, as well as the grace period, is capitalized or added to the outstanding principal balance that you owe. So you're going to see an increase in the balance of the loan at that point in time. And then going forward, you're going to be charged interest on the increased principal balance. So essentially you're being charged interest on interest. But like I said, this is a really typical term with student loans. So again, it's just really important to make sure that you understand if this is a term of your loan and how to handle it. Some people make payments throughout school if they can, and that reduces the amount of interest that gets capitalized and then compounded. So there are different ways to kind of manage it if you can, but it is typical of a student lending product. So we're not out of the norm by charging or having this feature.
Thank you, Katie. And Katie spoke a little bit about the not as favorable compounding interest when we're paying debt. Now, Carline, can you flip that and tell us about compounding interest in our favor with products such as CDs?
Exactly. Yeah. Katie had alluded to that. So I'm glad I have that end of it to tell you how you can make money. So for our CDs, I kind of touched upon it earlier, but when you have a CD and compounding interest work when it is the first set of interest is put into your CD and you don't withdraw it. And so it is left on that CD for that term. So if you had a CD for $5,000, and for example, and we added interest for you at $25 the first month. So, and if you don't withdraw that $25, the next month, we are going to add interest to $5,025. So that way your interest each time compounds and you get more money into the initial investment that you had added with us to begin with. So leaving it into the CD month after month after month, that's what gets you the compounding and gets you to make more money into your CD at the end of the year.
Thank you. So it seems like when we have debt, compounding interest, we want to try to pay that off as soon as possible, so we're charged less interest. And when we have savings, we want to save as much as possible so we can make that money. So thank you for clarifying. And now we're going to switch it. We talked a little bit about the interest and how it works in our favor. Katie spoke about compounding interest when it doesn't. So let's talk now about fees and what fees should we be looking out for?
Sure. The different fees, there's so many different fees that you have to look out for. And again, when you're not sure, please reach out to us, whether it's in person or via phone. But a few of the ones that come to mind when you first started is, there were certain products that have annual fees. We have certain checking accounts that have monthly fees. And within that checking account, we have what you call overdraft fees. And then you have your return check fees. Those are the overdraft fees, of course, it's if you don't have enough funds in your account and the bank pays out the funds for you. So you will be charged an overdraft fee. If you don't have enough money not enough money, I'm sorry. If you deposited a check that got returned, your return check fee, the fee to process it, that will be charged to you. When you are doing a wire, for example, there is a fee to process that wire, whether it's going international or it's going domestic, or if you're receiving wires as well. There are fees for those. So you want to look at those. Those are all in the disclosures, but a quick, simple call will solve all problems and tell you all of the fees that you may need to look out for. Also, when you're buying cashier's checks, for our members, when we're buying cashier's checks and the checks are made payable to them, there are no fees. However, if you are making the check payable to a third party, then there is a fee associated. If you're also buying a money order, there's a fee associated with that. So if you're buying foreign currency, there are fees associated with that. All of those is, you can certainly, as soon as you come in, ask, if there is a fee for the service. And typically we would absolutely tell you ahead of time, there are going to be fees associated with that.
Thank you, Carline. And, as we're doing today's presentation, of course, because we have Katie and Carline, who, our CFO and one of our branch managers, we are focusing and mentioning a lot of our products. And we hope you do all of your banking with us, but we understand if you go with someone else, still, this information is helpful. Family and friends, it's good to share the knowledge with them. And also remember that your families can also become members of the credit union. So I'll do that little quick plug there. But one of the questions that just came up, it had to do with what you just mentioned, and apologies for looking down as I read the question. But somebody asked, what are CDs and are they issued by banks? I don't know if Katie or Carline, if one of you wants to answer that before we move on to the next question.
Sure, I can answer that. CDs are certificate of deposits, and those are term accounts. So a lot of times you have your savings account that you can kind of get in and out of it. Those are activities. There are open accounts. You can make deposits to it. You can withdraw out of it. A CD or a certificate of deposit is a bit different. It is a savings, if you will, or an investment that you purchase for a certain amount of time. So it may be, the smallest amount of time is 3 years and the largest is 60 months. So you can go from, 3 months to 60 months, not 3 years. So you can go as little as 3 months to say, well, I have $5,000 that I'm not doing much with it. I'd rather see it grow a little more. I can lock it in for 3 months. The rate is doing great. I'm going to lock it in for 3 months. That means for the 3 months, you cannot touch that money. And if you do, then there are penalties that will be assessed to you. And and after the 3 months, then you would, at the end of the 3 months, you would have yielded, hopefully the annual percentage yield on the 3 months would have yielded what the rate was advertised.
Thank you, Carline. So I'm going to go on to our next question and ask this one to Katie, which is, are reward checking accounts or credit cards worth it? And I did see a lot of credit questions that came in, so we'll get to those after this one. But first, to get us started, are rewards checking accounts or credit cards worth it, Katie? What do you think?
So checking accounts and credit cards with rewards programs definitely can be worth it, but they're not always going to be worth it for every individual. Not every rewards program is going to make sense for every person. So it's important to understand both the rewards that are being offered with the product, as well as the eligibility requirements that are needed to be met in order to receive the rewards. So for example, our Smart Rewards checking account requires you to make 12 debit card purchases. You have to log into online or mobile banking once a month and get your statements received electronically, which is all very simple. But if you're not going to use your debit card 12 times during the month, then you're not going to be eligible for the rewards, and therefore it doesn't make sense for you to have this product. So there aren't always requirements like this, but if there are requirements, you just want to make sure that you understand what the requirements are and you're making a point to meet the requirements so that you can actually receive the rewards. And then in other instances, the rewards program isn't necessarily going to match your lifestyle. So there are travel rewards cards or there are gas rewards cards. And if you don't do much traveling, for example, this past year, a travel rewards card didn't make much sense for anybody to have. But now people might be traveling more, so it might be worth it to have a travel rewards card. If you don't have a car, it doesn't make sense to have a gas rewards card. So it just makes sense. It just makes sure that you know what the rewards are that you're getting to make sure that they make sense for you. So like I said, there are a variety of programs that institutions offer, and you just want to make sure that you understand the programs to make sure that they are worth it for you.
Thank you. And one of the questions that came in with speaking of credit cards is how many credit cards should I have? I'm not sure if either you, Katie, or Carline want to add something, and if I can also add as well if you'd like.
Katie, did you want to go since you're up already, and I can add to it anytime?
Sure. I think, again, this is kind of a lifestyle question. It depends on what your financial goals are. For me personally, I think it gets a little bit complicated when you have a lot of credit cards with a lot of balances. I know stores offer you credit cards, and if you have a lot of credit cards with a lot of balances, it just kind of it's hard to keep track of. So personally, I think the fewer the better. Also, if you have a lot of if you apply for a lot of cards, that can impact your credit score. The more times people look at your credit, it's going to go down. So it's not necessarily great to have a ton of credit cards, but it's also important to have credit available to you. So I personally would go for fewer cards with larger credit balances, basically.
For me, I'll give an example. I have the alumni card with HUECU, which that gives me a lot of different travel benefits. Yes, last year that didn't happen, but typically it does. But I also have a regular rewards card with HUECU as well. And that gives me a whole lot of different points, although my alumni card does give me the same, the points, the reward points in there. The other one, I use it more on a day-to-day basis than I would do my alumni card. So for me, having the two cards, it works. So again, like Katie alluded earlier, it really depends on the, where you are in your lifestyle.
And Carline actually just mentioned a good point for rewards. Sometimes the rewards on different cards have different expiration dates, and some don't expire at all. So it's important to know that as well, because if you're racking up all these rewards, but then you don't remember to use them, then that's not worth it at all. So make sure you know how to access the rewards to take advantage of them, and also make sure you know how long they're available to you.
Thank you, Val. So I have one other question before we're going to open it up for all the questions that we've received thus far. And I'm going to ask both of you, if you don't mind taking this one on, but what are my options if I don't understand the fine print?
Well, if you don't understand the fine print, the first thing that I would do is go on our webpage. The disclosures are there. The fine prints are there for you. However, if you prefer to have someone go over it with you, we are there at the branches. I would definitely encourage you to go to a branch if you want to do the in-person, or definitely call our support center. We're all here to help you understand your products, our products in your accounts. We don't want you to get to a point where you fall short at any point. So please give us a call or come and see us.
Yeah, and I think, just as I mentioned before, just make sure that you know that it's always okay to ask questions, and don't feel embarrassed or ashamed to ask anybody any questions. Whenever you get an account, whether it be a deposit account or a loan account, you get a ton of paperwork and disclosures, and feel free to go home, take the time you need to read through everything, and you can always call us back later or come back in later to ask us questions. And even if something changes throughout the term of your product and you weren't expecting it, or you just want to know what's going on, you can always reach out, and the MSRs are happy to help.
Thank you both. And we have a couple of questions that came in. So I know I have this slide up for folks to have the contact information you both have mentioned. And Sarah will also drop in the phone number as well. I apologize that it's not updated here. But one of the questions that came in regarding the fine print, what's the difference between cosigner and the primary borrower?
Carline, do you want to go on that one?
Absolutely, yeah, sure. The difference between a cosigner and a primary borrower is typically you would find an example of a parent and a child coming in. You know, the child just graduated college. They really don't have the credit or perhaps the equity to support the loan. And so what happens is the parent will come in so that the bulk of the responsibility is on the primary, who would typically be the child, responsibility to pay back the loan and to strengthen their credit, the credit history, their credit profile. But the cosigner definitely have the responsibility. If the primary falls short, the cosigner will, we will reach out to the cosigner to pick up where the primary falls short. So it's not as a joint, but they're still responsible for the loan as well.
Also, Carline, if you bring a cosigner on, can you sometimes be eligible for more favorable terms if the cosigner has strong credit?
Yes, because the cosigner will certainly, you know, again, it's the parent, excuse me. And so as parents, we've already bought our cars and loans and everything, and our credit score is higher. And that's what helps boost and help to approve the loan for the primary.
Thank you both. And Sarah will also drop it in the chat, access to Green Path Financial Wellness. So for anyone that has questions about their credit or wants one-on-one credit counseling or not quite sure, you know, it may be, to Carline's point, maybe the parent or the primary borrower has a higher credit score, but the secondary wants to bring up their credit score. As HUECU members, you all have access to Green Path Financial Wellness, and their accredited credit counselors will not impact your credit scores negatively. And it's a service that's available to help you and anyone in your household bring up credit score or just get a financial checkup. The next question that we have that was submitted was, are you able to add more money to a CD a few months after you open it?
Yes, there are certain criteria that needs to happen for you to do that. And it is if you are an elite member, and being an elite member with us at HUECU just means that you have 10,000 or more in deposit with HUECU. So at this point, when you are an elite member, you are given a one-time that you can add to your CD throughout for the term of that CD. So so it's not everyone that has that privilege. So you need to be an elite member for that to happen.
Thank you so much. And I don't see any additional questions at the moment. So I think what I would like to say is just a big thank you for both Carline and Katie for taking time today to help answer all these questions that we have. And also for anyone that joined, if you do have any questions in the future, do know that we're here as a resource. We're here to help you. And, you know, something that I think we probably can't emphasize it enough. If you don't understand the fine print, don't move forward. Wait, take time, give yourself time to understand it. We're here as a resource. And again, a big thank you to Carline and Katie for taking the time to help us better understand what is this fine print and how can we improve our finances. You will all get an email by Monday, which will have today's recording. You'll have the recording from all of our 4 sessions, including simplifying financial goals, simplifying investing, and simplifying student loan repayment. So by Monday, you'll get a email with the recordings. The videos will be uploaded to our YouTube channel if you'd like to follow us and subscribe so you can also get notifications. And thank you again, big round of applause, virtual Carline and Katie, for all your help today. And thank you, Sarah, for leading as well. Hope everyone has a wonderful afternoon, and thank you so very much.